Okay, I'm going to share my screen with you. Okay. Okay, so I think we should just browse through the slides quickly just to get a feel for what exactly is entailed in learning units 5 and 6. So let's quickly do that. Where am I? Desktop. Okay, so this is learning unit 6. You want learning unit 5. Okay. Yeah, learning unit 5 is relevant costing. And like I said, I'm just going to quickly browse through it. I don't want us to spend too much time here on the slides because you guys have access to this. But I just want to browse through it so that we get a feel for what it is that we are actually going to be going through. So relevant costing is all about future expected cost that changes when faced with different alternatives, okay? The principle of relevant costing is used by businesses to analyze alternatives and make decisions. That's what we are doing here. We're basically just analyzing cost so that we can make the necessary decisions. All right, should we invest in this? Should we not? etc, etc. So here they just break into the different types of costs that we can get. You can read through those in your own time, no problem. Okay. What else do we need to be aware of? There's non-cash items. Okay, non-cash items, things like depreciation. And then sunk costs, these are costs that have already been incurred. All right, we can't obviously make any decisions on them because they've already happened. Okay. Let's see, is there anything else? Make or buy. All right, so make or buy decision, they were saying, with make or buy decisions, we're saying, okay, cool. Should we make this product or should we buy it? Which one would make more financial sense for us? Should we make it or should we buy it? Okay. So based on the costing, it may be cheaper to actually have somebody make the product for us as opposed to us making it ourselves. Okay. All right, but let's move on. Okay, so these slides are actually very short. That's good. Discontinuation decision. Sometimes it also may, when determining whether to discontinue a division, department, or product line, the following should be considered. Extent to which the product or division consumes manufacturing resources. All right. The division or products are potential to increase demand in the long term. Okay. Then prevalence of competition. Those are the three amongst other decisions, other key factors you should consider. All right. I don't think you can really exhaust that thought process. But anyway, now that that's out the way, let's jump into the questions there. Okay, so I think let's start off with 5.1. Okay, right. Okay, there we are. Right, so in our textbooks, what page is this? In my textbook, at least. In my textbook, it's on page 124. Okay, and if we look at the required, they say there, calculate the production quantities of A and B required in order to maximize profits. Okay, so our objective there is to calculate the production quantities for A and B required to maximize profits. Then the second part is prepare a marginal cost statement, all right, in order to establish the total contribution of each product and the net profit for the period based on the selling quantities in I. Okay. Then the last bit there is calculate the production quantities of A and B, which would fully utilize both machine capacity and direct labor. Where applicable, direct labor hours were limited to 68,000 hours. Hint, you might need to use linear programming. Okay, right. So let's jump into, let's see what the rest of the question is telling us. It says Angel Pty Ltd manufactures two products, A and B, in its factory. Okay. Production capacity is limited to 106,000 machine hours. Okay. So already there we have a constraint. Let's see if it's a limiting constraint. Okay. It goes on to then say there is no restriction on the number of direct labor hours that can be worked. Okay, so we know direct labor hours is not an issue. Okay, we only have a limitation with machine hours. Okay, so far. Okay, the following budgeted information has been provided by management. Okay, so for product A, you can see there the total number of units demanded. All right, is, and this is a budget, remember it's a budget, 393,750. Okay, for B, 168,750. Okay, then we have the selling price per unit, we have the variable cost per unit, we have the fixed cost per unit, we have the machine hours per 1,000 units. Okay, and then we have the direct labor hours per 1,000 units. Okay, right. So now we can step into doing part one. Okay, part one, it says calculate the production quantities of A and B required in order to maximize profits. Okay, right. So first things first, we want to find out what is the marginal income per unit. Okay, so we then say to ourselves, all right, no problem. What is the selling price per unit? 14 Rand for A, 1960 for B. What is the variable cost per unit? 7 Rand, 80 for A, 10 Rand 80 for B. All right, then therefore the marginal income for A is 6 Rand 20. The marginal income for B is 8 Rand 80. Okay, now we want to find out what is the marginal income, also known as the contribution per unit, per limiting factor. Okay, so we know that machine hours per unit for A. All right, remember here they said in the book, they said per 1,000 units. Okay, so 200 per 1,000. So obviously we're saying 200 divided by 1,000 units. Okay, to get per unit. So that obviously is then giving us the 0.20 per unit. That's where that's coming from. Okay, and then we do the same thing for B. All right, to get this 0.34. Then we say to ourselves, okay, the marginal income per machine hour, all right, is 31 Rand. 31 Rand. And the marginal income for B is 25 Rand 80 cents. How are we getting that? We're taking this 6.20, and I believe we're then dividing it by the 0.20. Let's quickly see if I'm on the money there. Okay, so that's how we're getting the 31 over there. Okay, that's how we're getting our marginal income per machine hour. Okay, and the reason why we're doing this, we're trying to say which of these two products is going to give us the most income for this limiting factor. Remember, we only have 100 and how many? 6 hours of machine hours. So if we have a limiting resource, we then need to say which resource is going to give us the most bang for our buck. I mean, sorry, which product is going to give us the most bang for our buck? So here what we're then doing is we're saying, okay, this one is 31. And if we want to calculate B, just to, so again, we're saying 0.8 divided by 0.34. Okay, and that's how we're getting this 25.88 cents. Okay, so we then go on to rank which product gives us the most money or the most bang for our buck. And here you can see it is A. Okay, that's why we've put 1 here. So this one's number 1, and this is obviously then comes in number 2. Okay, we only have 2 products, but if we had 3, 4, we'd also rank those. Then how we then move forward is we say, okay, to find the most optimal number of products that we should produce, we then say to ourselves, okay, no problem. Let us produce all the number of units that we want to produce for A, and then whatever we have left over, we will then produce for B, since B brings us a little less money than A does. Okay, so then we say, okay, so we know that we need 0.2 machine hours, okay, to produce 1 unit. Okay, so we say, okay, we know that we want to produce 393,700 units. Okay, so how many machine hours do we need in order to produce all 393,750 units? We then say, okay, we know we need 0.20 machine hours, so we times that, and then we say, okay, we need a total of 78,750 machine hours. 78,750 machine hours. Okay, cool. That's how many machine hours we need to produce all of A, which is going to give us the biggest bang for our buck. Then we say, okay, B, whatever machine hours we have left after that. So basically, let me do this calculation right here. We're saying, let me do it on my calculator, because this is not going to calculate for us. So we're saying we have a limit of 106,000. 1, 2, 3 hours, and then we say minus, we're saying 78,750 is going towards A to produce all of A. Okay, so we only have 27,250 machine hours available. That's where this is coming from. Can you see that? So here, in terms of number of units, here you can see we've put all the units for A. We are producing all the units for A. But we only have 27,250 left for B. So we say, okay, based on those machine hours, how many units of B can we make? Okay, we know that it takes us 0.34 hours to produce 1 unit of B. So we say, okay, 27,250 divided by that will then give us how many units we can actually make. Okay, and here you can see we only make 80,147 units. Now, if you look in the table there, how many units did we want to make of B? We actually wanted to make 168,750. That's how many units we actually wanted to make. Okay, that's how many units we actually wanted to make. So, guess what? We've now found our answer to A. The number of units basically that we want to produce for our products, okay, our products A and B. This is the optimal, because remember A is going to give us the most bang for our buck, so we want to produce as many of that. Okay, so that's part one. The next part, they say prepare a marginal cost statement, okay, marginal costing statement, in order to establish the total contribution of each product and the net profit for the period based on the selling quantities in I. Okay, so this is basically just like an income statement. All right, so here you're basically saying, okay, what was the amount of sales that we made? Okay, the amount of sales that we are going to make is that 393,750, and here 80,147, and we know that the contribution per unit is that. You could also start with the selling price, okay, then obviously include the variable cost, and it's just a longer way, but then you arrive at this same amount here of 2,441,250, and you arrive at this contribution or marginal income also of 705,298 for product B. You add those two together, you obviously get this 3 million. That's now your total marginal income. All right. Then you say, okay, what about my fixed costs? Okay. Now, remember, fixed costs are fixed costs. They don't change. Okay. So here, these fixed costs are based on the total number of units that we wished or budgeted to make. And that's why here they're doing it based on the total number of units. Okay, so that will then give you a negative of 3,108,938, and then finally you have a profit of 37,607, right? Cool. Then, so that's part two. Part two is pretty much just a profit and loss statement with the information you have available to you. Right, part three, there they said calculate the production quantity of A and B, which would fully utilize both machine capacity and direct labor hours, okay, where direct labor hours were limited to 68,000 hours. Hint, you may need to use linear programming. Okay, so this is pretty much taking something from our learning unit, your learning unit 4. Okay, so here we have to first put together the objective function. Remember, the objective function is to say, what is the marginal income that we get from product A? What is the marginal income that we get from product B? Okay, And we calculated that up top here. All right, marginal income for B, 8.8 Rand 80. For A, 6 Rand 20. Okay. And so there you have it. Okay, there is your objective function. Then you say, what are my constraints? So in this case, we have machine hours. I'm going to actually just write that here. Machine hours is our constraint. And also, they've just told us that direct labor hours is our other constraint. Before it wasn't a constraint. Okay, that's why here we just said, look, let's do our calculations based on machine hours only, because that was the only limiting factor. Okay, now here we have 2. Okay, so we know that already. We know 0.2 labor hours, sorry, machine hours, to produce 1 unit of A. All right, and here we also know, sorry, here, how much is it? This should actually be 0.34. I think they made a mistake over there. Okay, 0.34 to produce 1 unit of B. Okay, and that's the equation that we have there. Then here we do our calculations as well to say, okay, how much direct labor hours to produce 1 unit of A? So if we look there, again, you can see what they've done is they said 1,000 units, it takes up 150 hours, direct labor hours. So we say 150 divided by 1,000, and that's how we arrive at the 0.15. Okay. Same principle for B. We say 175 divided by 1,000 will then give us 0.175. Okay. All right. Awesome. So that's how we got those there. Right. Then we build our equation for direct labor hours, and then now this is the part where we again now need to solve for B. Okay, this would typically be be X. Okay, because you know Y would make that usually Y. So we then solve for B. After you solve for B, we then solve for A by substituting in B. Once you've done that, you'll find that your optimum number of products for A, or units for A, would be 285,625. And then for B, it would be 143,750. Okay, right. So that's pretty much how. Let me see if I maybe did the solving for B and solving for A with my student on this other activities here. Obviously, we have so many exercises to get through. Yes. So here I'm just showing you what goes into solving for B. So here you can see we made this the subject. We made B the subject, and there you can see we threw this over. We threw that over just to make sure that we isolate B, and then we began to solve, to calculate. Say, okay, how do we get rid of this to isolate B? And we did that there. We then solved for B. Okay, after solving for B, we can then solve for A. Okay, all right. Okay. Yeah, so here, if you know your simultaneous equations, that goes a very long way. That goes a very long way. Okay, let me see if you all have any questions or thoughts. All right, we're still good. Cool. So let's move on to 5.2. Make or buy decisions. Make or buy decisions. Okay. Make or buy decisions. Remember, with make or buy decisions, just before we get into the question, remember with make or buy decisions, we're saying, should we make or should we buy this product? What should we do? What should we do? Should we make or should we buy this product? Okay. Is it cheaper for us to make or buy this product? Because remember, we're going for the cheapest option because the cheapest option will yield us the higher profit. Okay, right. So let's see what's going on over there. Let's see what's going on over there. Under the required, it says the following. For each of the scenarios below, determine whether the component should be purchased from an external supplier or manufactured internally. Use the given cost criteria only and note any assumptions that should hold. Okay, that's the first bit. So use the given cost criteria and note any assumptions that should hold. Okay. All right. Then the second bit, they say, assuming government legislation requires that the company to undertake quality inspections and testing costing 62,900 per annum, not included in the expenses above. Okay. So based on that information, that's basically like a fixed cost now, because you have to pay it. We need to obviously meet this legislative criteria. Okay, so basically our costs are going to go up. Should we actually continue to produce this product, or should we actually allow it to be produced externally? Okay, the information into account. Okay, excellent. Did you switch on your mic? Would you like to say something? Okay, guess I'm just echoing back. Okay, I hear something there in the chat. Okay, all right, no, that's fine. Cool. Right. Then we go on to the next one, the last bit of the question. It says, assuming additional labor cannot be recruited and only labor released will be employed to in increasing production of an existing product with a selling price of 101 Rand per unit and the following budgeted manufacturing costs. Okay, assuming additional labor cannot be recruited and any labor released will be employed in increasing production of an existing product with a selling price of 101 Rand per unit. The following budgeted manufacturing costs. Okay, what now must happen here? Okay, so here I think they're just giving us additional information. Let's see. Okay, we'll see when we get there. But let's tackle the rest of the question. All right. Bucks Ltd produces a component that it uses to manufacture a final product. Okay. The manufacturing costs of the component are as follows. Okay, so this is a component. All right. The manufacturing cost of a component, right? A piece of equipment or stuff that we need in our business. The cost of the component, direct materials, all right, 15 Rand 50. Okay, then this is probably per unit. Direct labor. Oh, take note, when they say the manufacturing cost, that means the cost to us if we're to make this ourselves. Okay, right, direct labor, 5 Rand at 5 hours at 2 Rand 50 per hour. Okay. Then we have the variable overheads, 5 hours per unit at 2 Rand per hour. Okay, that's how we're getting the 10 Rand. Okay, and then obviously fixed overheads, we have 5 Rand at 4 Rand 20 per hour. Okay, and that's how we're getting the 21 Rand there in the table. So the total cost per unit is then obviously 59 Rand. Okay, cool. An external supplier has offered to supply the component at a guaranteed price of 55 Rand per unit. For each of the following scenarios below, determine whether the component should be purchased from the external supplier or manufactured internally. Using the given cost criteria only, note any assumptions that should hold. Okay, so using that criteria, we're saying determining whether the component should be purchased from the external supplier or manufactured internally. Okay, so the purchase price from the supplier per unit is that 55 Rand. Okay, then we say variable costs to manufacture per unit. Variable costs, there we have the 15 Rand 50, we have the 12 Rand 50, and then we have the 10 Rand. Okay, we don't include the fixed overheads because that's not a cost directly related to the product. Okay, so then we say the difference between how much it would cost to produce the unit, right? Because fixed costs, remember, fixed cost is in relation to your lights, your telephone bill, your rent. Those things are not costs that are resulting as to are not costs as resulting to the number of units that you make. All right. Remember, your electricity is always going to be that amount. Your water is going to be that amount, regardless. Well, let me not say water, but your rent, all right, is going to be what it is, regardless of whether you produce a unit of your product or not. Okay. So we then are only including variable costs. So that 55 Rand minus your variable costs then gives you 17 Rand. So we would be saving 17 Rand if we manufactured the unit, the component ourselves, if we manufacture that product ourselves. So obviously here, the recommendation will then be to manufacture the product ourselves, okay? Right. Then let's go to the second bit there. It says, assuming government legislation requires the company to undertake quality inspections, okay, and testing costs, 6,900 per annum, not included in the expenses above. Okay, so now what's happening here is we then have this 62,900. If we produce 3,700 units or more, then we should manufacture it. Okay. Well, basically what we're doing is we're saying, okay, this is a fixed cost that has arisen as a result of obviously this product because of the inspections. So we're saying to ourselves, okay, if we can actually cover the fixed costs as a result of selling this component, then we should produce it because we are only incurring this as a result of this product. Okay. But then we have to say to ourselves, but how many units do we need in order to cover this fixed cost? Okay. So then we say, okay, cool. Let's use the saving element, which can be viewed in a sense like the revenue that we'd be generating as a result of not paying that to the supplier. Let's use that as the marginal income, okay? And then we say that marginal income, remember break-even formula is, the break-even formula is, do this, fixed costs divided by your selling price minus your variable cost. Okay, so this is basically, I'm going to highlight it in yellow now, your marginal income. Okay, so it's the same as saying, okay, we know that we're having a cost saving of 17 Rand. So we then say, okay, our fixed cost of 62,900, which is our fixed cost, yes, divided by that marginal income or that cost saving of 17 Rand. Okay, and that's where they're then getting the 33,700, okay, units. Okay, so basically, if we can make these units, that means we won't make a loss in terms of the fixed costs. All right. So here it's saying, if you check the answer, the recommend, if we produce 3,700 units or more, then we should manufacture. However, if we produce less than 3,700 units, then we should buy the component, okay? Because then we won't be able to cover this fixed cost. So it's better we just actually buy the component and forego this cost saving. Okay, that's pretty much what they're saying over there. Okay, right. Then the last bit, and I think we'll take a break after this one, after this last bit. Let's see. What other, let's see quickly. Okay, we'll see. Yeah, okay, so then that third bit, it says, assuming additional labor cannot be recruited, okay, so we have a limiting factor here, additional labor cannot be recruited, and any labor released will be employed to increase production of an existing product with a selling price of 101 Rand per unit and the following budgeted manufacturing costs. Okay. Also, basically, they're saying that we can't actually release any labor towards this component. So, because we're using that labor for a certain product which sells at 101 Rand. Okay, so here determine whether the component should be purchased from an external supplier or manufactured internally. If additional labor cannot be recruited, if we don't have labor for this component, basically. So they're saying the contribution margin of existing product. In other words, the product that that labor is being allocated to. So they told us the selling price is 101. Then what we want to do there is remove, to get the marginal income or the contribution per this product, we then have to remove the variable costs there. Okay, So there you can see the 11 Rand from direct materials. And there you can see the 31 Rand 50 from direct labor. And then finally you can see the 22 Rand 50 from variable overheads. All right, because remember our selling price, as you can see here, minus our variable cost, sorry, gives us then our marginal income, okay, or our contribution. And that's how we're getting the 36 Rand. Cool, no problem. Then we say direct labor hour per unit. We know that it's 9 Rand, sorry, 9 hours per unit, okay? So then we're saying, what is the contribution per labor hour? Remember, this is what we did in the first one. We said, okay, what was the contribution per unit of the limiting factor? Okay, what was the contribution according to the limiting factor? So that's what they're doing here, contribution per labor hour. So 9 into 36, that's how we're getting this 4 Rand. Okay, then we're saying, okay, cool, no problem. Relevant cost of manufacturing component is, right? We've got the variable cost of 38 Rand. Remember, it costs us 38 Rand to produce it ourselves. All right, so we got that 38 Rand. Then we're saying, how many hours will it take for us to produce 1 unit of that component? All right, it costs us 5 hours, or it takes us 5 hours per unit. So 5 hours times this money that we would be foregoing if we don't produce this product that gives us 101 Rand. Okay, so we're saying 4 Rand, the money we would be foregoing, the contribution or the marginal income we'd be foregoing if we produce this this component. 4 Rand times the 5 hours it takes to produce that component, that's where we're getting this 20. So the total relevant cost now is this 58. All right, 58 versus what the supplier says they're going to charge us, which is 55 Rand per unit. We then say, whoa, it's actually cheaper for us to outsource this than for us to try and produce it ourselves. Okay, there you can see loss if component manufactured, 3 Rand, negative 3 Rand. Okay, hence the component should be purchased from a supplier. Okay, so can you see now how our relevant costing is helping us to decide whether we should buy or manufacture the product? Okay, all right, in different scenarios. Okay, so that is your question 5.2. That is your question 5.2. Okay. I'm trying to see here. Okay, cool. All right, so I think let's take our break. Let's take our break, and then when we get back, we will continue with 5.3. Yeah, we'll continue with 5.3, and then we'll see from there where to go from there. Okay. All right, so excellent. If we can be back. Oh, we have others who have joined us. All right, awesome stuff. Guys, if we can be back by, yeah, let's make it 9. Then we can take off from there. All right. See you guys in 13 minutes.